Warren Buffett reveals his 7 key investing rules that helped him amass an impressive 29.5% average return during the nascent years of the Buffett partnership. The rules reflect the wisdom of a man known for his financial acumen and his ability to make smart, calculated decisions in the erratic world of investing. Investment is a realm where ordinary individuals can thrive by using common sense and sticking to uncomplicated strategies.
You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Buffett's approach is refreshingly straightforward. His wisdom lies in the understanding that investing doesn't require a genius-level IQ. Instead, it demands a clear and rational mindset, devoid of unnecessary complexities. As we delve deeper into this section, we will decipher the 7 rules that form the bedrock of Buffett's investment strategy. Warren Buffett's first rule is nothing short of a game-changer. It was a pivotal turning point in his life when he unearthed the significance of owning a stake in a business. This revelation occurred during his time spent engrossed in the pages of the enlightening book, The Intelligent Investor, written by the renowned author and value investing pioneer Benjamin Graham. It articulates that if the business succeeds and flourishes, the stock will follow suit. This principle, when applied correctly, has the potential to yield significant monetary rewards. Buffett's rule underscores the importance of thorough research and careful selection when it comes to stock investments. It is not just about hopping on the bandwagon of the latest market trend. Rather, it is about comprehending the business model, assessing its potential and future growth prospects, and most importantly, having patience. Investing is not a sprint, it's a marathon. A race to identify the hidden gems in the market, companies that hold the potential of shaping our future. Companies that can innovate, disrupt, and redefine the market landscape. Companies that are poised for sustained profitability and market domination. Companies poised for future domination and sustained profitability are out there, waiting to be discovered. Buffett's perspective on news consumption might surprise you. His point of view on the topic might challenge your conventional understanding of how you should consume news, especially when it pertains to the world of investing. The billionaire investor, known for his wisdom, believes that a majority of what is presented as news is nothing more than noise, an invasion of your thoughts and a source of undue anxiety, especially within the sphere of investing.
How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth, and I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's simply an intellectual process, and the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your level, defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value.
It implies that the majority of the information, even though packaged as essential and breaking news, is irrelevant and unnecessary. This noise can be especially prevalent and misleading in the investing. This is because such news pieces often create an illusion of urgency, spurring investors into making hasty decisions. This leads us to explore the dangers of following the herd. The notion of following the herd refers to the tendency of individuals to follow a majority or popular opinion. You see, when we succumb to the herd mentality, we tend to overlook the critical aspects of an investment opportunity and instead get swayed by the flow of the majority. This can be a perilous path, leading to poor investment decisions. It is crucial to the right kind of information, to filter out the noise. Paying heed to unnecessary information can lead to information overload, causing mental fatigue, stress, and ultimately poor decision-making. We must learn to distinguish between news and noise, between what is essential and what isn't. This will help us focus on the critical details that truly matter and make better informed decisions. Compound interest is a powerful tool in Buffett's arsenal. This financial genius, known for his market acumen, employs this strategic tool not just for temporary profits, but for long-term wealth generation. When we delve deeper into the concept of compound interest, we unravel the true potency of adopting a long-term investment mindset. This is why Buffett, despite his capacity to make quick money, chooses to play the long game. Making use of this concept, he patiently waits for his investments to grow exponentially over time, rather than hastily cashing in on short-term gains. This brings us to another vital point. Time in the market often trumps timing the market. In the world of investments, the waiting game can be more rewarding than trying to time your entry and exit points. Why? Because trying to predict market trends is often a gamble, whereas allowing your investments to grow over a consistent period provides more predictable and often higher returns. We can see this principle at play in Warren Buffett's timeless holdings like Coca-Cola and American Express. Buffett didn't become the Oracle of Omaha in isolation. His success story is one that's intricately woven with the wisdom, guidance and camaraderie of those who influenced his journey. A pivotal figure in his life was undoubtedly Benjamin Graham, often considered the father of value investing. Graham wasn't just a mentor to Buffett, he was his guiding light. He provided the young investor with the principles that would frame his investing pattern. These principles were a beacon, illuminating the path to calculated decisions based on a company's intrinsic value. Another key figure in Buffett's journey was Charlie Munger, his longtime business partner and the vice chairman of Berkshire Hathaway. Munger brought a unique perspective to Buffett's style and methodology, introducing him to the concept of quality investing. Learn why it's crucial to listen to those you know and trust, filtering out the noise from self-proclaimed experts who might not have a deep understanding of the market. Warren Buffett's portfolio stands as a profound testament to his unwavering commitment to understanding the intricate workings of the companies in which he invests. Through careful analysis and deep study, Buffett looks beyond the mere numbers and dives into the heart of a company's business model before making any investment decision. This exploration of the importance of having an in-depth understanding of a company's business model prior to buying its stock is an essential aspect of his success story. It's about understanding not just the business, also its leadership, its vision, its financial stability, its market position, its competitive edge, and its potential for growth. It involves scrutinizing the company's balance sheets, revenue streams, profit margins, and debt levels, among other key financial indicators. And yet this principle goes beyond mere financial considerations. Buffett's approach also applies to how one's personal interests, passions and expertise can influence their investment decisions. It's a process of aligning interests with investments, thereby enhancing the chances of success. For if you are passionate about technology, you might be more inclined to invest in tech companies, given you have a better understanding of the industry. Likewise, if you're passionate about fashion, investing in fashion brands might seem a more logical move. It's about leveraging what you know and, even more importantly, what you love. As we delve further into this discussion, we underscore the importance of investing in what you. The idea is not to blindly follow trends or invest in the hottest stocks. Rather, the objective is to make informed choices, guided by a deep understanding of a company's business model and your personal interests, ultimately leading to smarter, more successful investments. Timing is everything in investing, particularly in today's unpredictable market conditions. It's crucial to recognize that each market environment is unique and offers a distinct set of opportunities and challenges. In this context, unfolding the wisdom of the world's most successful investor, Warren Buffett, can provide us with significant insights. Buffett's investment strategies have consistently demonstrated that patience and discipline are the keys to yielding high. A bull market is characterized by optimism, investor confidence, and expectations that good results will continue. On the other hand, a bear market is a condition where securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. The current market scenario is a complex amalgamation of these two extremes. Volatility, uncertainty, and unpredictability are its defining characteristics. This scenario necessitates a unique approach to investment, combining elements of caution, foresight, and courage. Now, let's revisit Buffett's timeless advice. Be fearful when others are greedy, and greedy when others are fearful. This philosophy underscores the importance of contrarian thinking in investment. It suggests that the best opportunities come when investor sentiment is at its extreme. Applying this philosophy can lead to strategic investment decisions. When others are overly optimistic and prices are high, exercise caution. Conversely, when the market is overwhelmed with pessimism and prices are low, we will delve into the depths of Warren Buffett's golden rule, that is to always purchase at a price that falls below the intrinsic value.
If you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
This pivotal tenet of investing has seen decades of application and has been a cornerstone of Buffett's success. Intrinsic value refers to the real worth of a stock, as opposed to its current market price. Why does this matter? Simply put, if you're able to accurately calculate a company's intrinsic value and find that it exceeds the current market price, you've found an investment opportunity worth seizing. It's these undervalued stocks that can yield significant returns when the market finally recognizes their true worth. In the end, it's not just about buying low and selling high, it's about recognizing value where others do not. Concluding, we'll introduce a valuable resource for understanding intrinsic value and making informed investment decisions.